Robin Flynn filling in for Elias Makos. The cost of living is really high. Really high, guys. We're spending so much money on our lodging, whether that's rent or your mortgage. We're spending tons of money at the grocery store. Gas is expensive. Every single streaming service, cable, everybody's increasing their prices, and our wages don't seem to be following, at least not as quickly. But maybe we can find a few ways to help save you some money. So a few federal policies are coming into effect this year that will have an impact on your pocketbook. Notably, tax brackets will increase by 2.7%, and the basic personal amount is going to increase as well. And there could be more changes coming to the capital gains tax. Now, the legislation hasn't been passed on that one yet, but it is something that you will need to consider if you're selling off an income property or some investments, some assets, anything like that. So we're going to dive into that now with Moshe Lander. He's a senior lecturer in economics at Concordia University. Good morning.
Hello.
I want to start with the capital gains tax switch, if we may, because I know there was a change made to the capital gains tax last summer. What other proposed changes could be coming?
So really, it's going to be an issue of, does this government survive long enough to make sure that that legislation goes through and remains in effect? The capital gains changes are going to be for people who have, say, second residences or large amounts of investments and assets and are liquidating them. If you don't have a lot of assets, if all you have is your primary home or you're not nearing retirement, then it's probably not going to affect you in any substantial way. And so it's one of those things that the government put in place as a way to try and create equity. And really, it was just meant to go after the rich.
Okay, so for the average person who owns only one home and doesn't really have a ton of investments, this isn't really going to impact them at all.
No, because when you only have one home, I'm saying only, then when you go to sell it, it's not a capital gain. It's your primary residence. It's only if you have a second residence. So if you have a cottage up north or if you have an investment property, that's where you have to worry about it. But presumably, if you have the capacity to have a cottage or an investment property and you're looking to sell it too, that's where it's going to get you caught up. But even there, if you're not looking to sell it, there's no harm at this point.
Okay. Now let's talk about tax brackets. When we say tax brackets will increase by 2.7%, what does that mean?
So the threshold at which your taxes increase is being raised. So I'm making up numbers just to keep it simple. But for most people, give or take, the first $20,000 in income is tax-free. After that, starting with $20,001, you start paying about 20 cents on the dollar. Once you get up to around 50,000, then you start paying a little bit more on each dollar after that and so forth. So what the government usually does is they will index it to inflation. So that means that if your income is going up, then that $20,000 threshold might now kick in at around $21,000. So it means that the extra $1,000 will be tax-free where it wasn't before. And it's meant to reflect that our incomes are supposed to be going up, and so the threshold at which your taxes start to increase should go up in line with that as well. You think about, say, somebody earning $100,000 right now, that's above average for sure, but 20 years ago, earning $100,000 would have put you in a much more elite status. So the thresholds need to adjust to try and reflect that $100,000 doesn't get you what it used to.
And that basic personal amount is part of that first sort of tax bracket, right? Where it's tax-free. I remember this was fun when I was a teenager because you're taxed at source, but then at the end of the year come tax time, I'd get all that money back in a juicy refund. It was good to be 16 in April.
That's exactly it. And so when HR departments process how your paychecks are done, usually the software will process that it assumes that you're going to earn the same amount every week for 52 weeks. And whether you get paid every 2 weeks or every 4 weeks, the taxes that are deducted are based on that assumption just because it keeps the software easy. And so if you have unsteady work or if your pay changes dramatically from 1 week to the next, you might be very much overpaying. And so at the end of the year, it says, look, we just needed to make sure that we were collecting something from you to make sure that at the end of the year, you wouldn't say, well, I spent all my money. I don't have money for taxes. And then, it turns out that you overpaid, then you get it back.
Now, if somebody does their own taxes, obviously lots of people use accountants, but some people do their taxes themselves. Me. Does this change anything that we need to be aware of, or will, programs like UFile and stuff like that already have these changes built in?
So they should have it built in. You'd probably be asked somewhere in the next couple of months that your software needs like a major upgrade. And the reason that it's an upgrade is because the back office calculations would all be changed automatically to reflect new laws or new thresholds. Same thing would be then for EI, CPP, QPIP, all of those sorts of deductions that you might get on your paycheck. Those amounts also change as well this year, and so it should reflect that. Even if you do it even more old-fashioned, where you don't even use software, if you go to, say, Canada Revenue's website or the Quebec government's website, they'll tell you straight up that these are the basic amounts for the various thresholds and what you do and don't qualify for. The value added of an accountant, of course, is that they'll also know where maybe some of the loopholes are that people doing it themselves wouldn't necessarily know where to look.
Yeah, it's important to know what kind of things you can claim on your taxes as deductible expenses. Prescriptions from your doctor that may not be covered by your insurance, those you can still claim at the end of the year, right? So it's important to know what are eligible tax write-offs.
For sure. And also what the deadlines are as well, right? So sometimes through your employer, you might be eligible for certain things, but the paperwork has to be filed by a certain deadline. And so even though you might have all of the documentation, they might say, listen, we close our accounts on April 15th, and if you haven't submitted a claim, then you wouldn't be eligible for reimbursement for 2024. So it's also one of those things to just double check with your HR department or whoever handles payroll. What are the deadlines that I can even apply for those things? There's all kinds of unclaimed benefits that we're eligible for that we don't necessarily use because we don't know that they exist, right? Who reads the fine print on their insurance coverage as to every last nickel and dime that you can claim? There's thousands of dollars every year for individuals that go unclaimed. Multiply that by millions of Canadians. There's a lot of money that's left on the table there for people that are really struggling.
Are there any changes coming to pension plan contributions that we should know about?
Yeah, so the pension plan changes year to year, and in part it's because in Canada we have what's called a pay-as-you-go system. And so current retirees are effectively living on the pension contributions of current workers. Of course, as more and more baby boomers retire and as they live longer and longer, and as there's less of us in the subsequent generations, Gen X and Gen Z and so forth, that are working, our amounts that we have to pay have to go up because seniors don't take too kindly to government saying, there's not as many workers, therefore we don't have as much money for your pension, so we're just going to cut things out. Seniors vote in large numbers. They want their pensions left as they are, indexed to inflation, increases where possible. And so we are going to see that there's a little bit more that we're expected to pay into our pension contributions. It shouldn't be a substantial amount in the grand scheme of things. I don't know that that's going to be the difference between survival or not in 2025. And if it is, then you have a much, much bigger financial issue than merely whether there's a marginal change to pension time deductions.
Wrapping up with Moshe Lander, Senior Lecturer in Economics at Concordia University. Before I let you go, what policy coming into effect in 2025 is the one that will impact people the most or that they should be on the lookout for?
Well, I hope that we stop talking about inflation in 2025 because it's back to where it has been for the better part of the last 30 years. There are interest rate cuts coming in the next 12 months, probably 4 of them. And so that's a full percentage point that I expect to be cut out. There's a large number of Canadians that are going to see their mortgages renew in 2025 and 2026. So every little bit that's cut is a potential benefit. It's not a policy change per se from the government, but it is a policy change coming from the Bank of Canada. And I think that's going to be way more important than any changes to the tax code. Those are going to have marginal effects, but the ability to breathe a little bit easier in 2025 and know that your house is safe or that your living arrangements are safe, that's probably the biggest one that I'm watching for.
As somebody with a variable rate mortgage, I am very, very closely monitoring the Bank of Canada announcements, and I would love another percentage point drop in 2025. Moshe Lander, Senior Lecturer in Economics at Concordia University. Thank you so much for your time today.
Anytime.